3 ETFs. That's it. By the end of this video, you'll have a complete investing portfolio built for 2026 and beyond. No guessing, no complexity, just a proven low-cost structure that serious investors have used for decades. VTI or VOO, VXUS or IXUS, BND or AGG. Simple on the surface, but the details inside these choices could mean tens of thousands of dollars difference. Here's what most beginners never figure out. Here's the thing. These quietly stole $24,300 from a $50,000 investment over 30 years. That number stopped us cold. So we built this from real data, expense ratios, 10-year returns, max drawdowns, tax placement rules. Every number you'll see is sourced and verified. No guesswork, no sponsored picks. Just the math working for you or against you before picking any ETF. Understand the environment they're entering right now. The Fed funds rate sits at 4.25 to 4.5%. Inflation at 2.4%. The 10-year Treasury yield at 4.1%. That's a completely different world from 2021's 1.5% yields. Bonds actually pay you something again. That changes the three-fund math significantly. Look at 70 years of rate history. The Fed hit nearly 20% in 1981, then collapsed near zero after 2008. Now we're back to 4.3%. Why does this matter? Bond ETFs like BND and AGG suffered their worst drawdown ever in 2022 because rates spiked hard. But now, higher yields mean bonds actually generate real income again. The CPI chart tells a brutal story. Prices have risen 16 times since 1950. That's not a typo. 16 times. Your grandparents' dollar is worth 6 cents today. This is exactly why sitting in cash destroys wealth silently. Stocks have historically outpaced inflation by miles. Bonds partially keep up. Cash loses every single year. The three-fund portfolio exists specifically to fight this slow erosion, and the numbers prove it works. This report was built using Yahoo Finance data, expense ratio disclosures, and historical return records. Real numbers. Real sources. Nothing fabricated. We cross-reference drawdown figures and return histories across multiple periods. Why does methodology matter? Because YouTube is full of ETF videos built on vibes, not data. You deserve better than that. Every claim in this video has a number behind it, and the number coming up on the next slide. 7 ETFs, 1 table. Here's what jumps out. VTI and VOO both returned over 12.5% annually over 10 years. VXUS returned 4.3%, BND, just 1.5%. But don't dismiss bonds yet. Max Drawdown tells the real story. Stocks dropped 55% in 2009. Bonds only dropped 17% in their worst year ever. Different jobs, different roles. VTI holds 3,600 stocks. VOO holds 500. Sounds like a massive difference, but 82% of VTI's weight is already those same 500 companies. The performance gap over 10 years? About 0.2% annually. Basically nothing. So which do you pick? It's almost personal preference. $24,300. Gone. That's what a 1% fee fund costs versus a 0.043% ETF on $50,000 over 30 years. The low-cost portfolio grows to $121,000. The high-fee version, $97,000. Same market, same 30 years, different costs. That gap is a vacation home, a kid's college fund, retirement comfort. Fees aren't boring fine print. VTI versus VOO, head-to-head 2019 through 2023. In 2020, VTI actually beat VOO 21% versus 18.4%. Small caps carried it, but in 2021, VOO won 28.7 versus 25.7. Back and forth year after year, and on $50,000, the total difference across 5 years was roughly $50. Not 50,000, 50. Here's a concept most beginners skip: the Sharpe ratio. It measures return earned per unit of risk. Higher is better. The blended 3-fund portfolio, 60% VTI, 30% VXUS, 10% BND, delivers more efficient returns than VOO alone. You're not just adding bonds for safety, you're improving the quality of every percentage point of return. Risk-adjusted thinking separates serious investors from lucky ones. 2022 broke the assumption that bonds always protect you. BND dropped 13% that year. Stocks and bonds fell together, something that hadn't happened in decades. On a $50,000 portfolio with 10% in bonds, You lost roughly $650 on that bond slice alone. Not catastrophic, but not the cushion anyone expected. The lesson isn't to abandon bonds. It's to understand what they actually do. VXUS or IXUS. Here's the clear answer. VXUS costs 0.07%. IXUS costs 0.09%. VXUS returned 4.3% annually over 10 years. IXUS returned 4.2%. VXUS also holds private 700 stocks versus 4,300 in IXUS. More diversification, lower cost, better returns. The 0.02% difference sounds tiny. Adding VXUS to VTI or VOO doesn't create redundancy. It creates genuine diversification. VTI's top holdings are already 82% of VOO, but VXUS adds 7,700 entirely new companies. Japan at 16%, UK at 9%, China at 8%, 75% developed markets, 25% emerging. These economies don't always move with the US market. When America struggles, international can outperform. You're not doubling up. Rebalancing frequency matters more than most beginners think. Annual rebalancing consistently outperforms quarterly in studies, not because of better timing, but because of lower transaction costs and fewer taxable events. Every time you rebalance in a taxable account, you may trigger capital gains. Doing it once a year keeps that cost low while still maintaining your target allocation. The discipline of once a year beats the anxiety of checking every quarter. Account placement is silent wealth. BND generates bond interest taxed as ordinary income, potentially your highest rate. Hold it inside your IRA or 401k. VXUS dividends are sheltered there too. VTI and VOO are your most tax-efficient holdings. Qualified dividends, low turnover, so they're fine in taxable accounts. Even the most conservative 3-fund allocation, 60% stocks, 40% bonds, returned 8.7% annually from 2010 through 2024. $50,000 grew to roughly $163,000. The aggressive 90-10 split, 11.2% annually, $218,000. That's a $55,000 difference. Just from allocation choice, not stock picking, not timing the market. Right now, the biggest debates among real investors are these three. 1. VTI versus VOO. The data says it's personal preference, 82% overlap. 2. International allocation. VXUS inflows shattered records in 2025, according to Morningstar. Smart money is moving. 3. Bonds for young investors. 2022 proved bonds can fall with stocks. Younger investors are increasingly skipping them entirely. These aren't academic debates. Here's your set and forget portfolio. First block, VTI or VOO, 0.03%. 60 to 90% of your portfolio. Second block, VXUS, preferred over IXUS, 0.07%, 10 to 30%. Third block, BND or AGG, 0.03%, 0 to 20% based on your age and risk tolerance. Keep total costs below 0.1%. Rebalance once a year, $24,300. That's what high fees steal over 30 years. The 3-fund portfolio, VTI, VXUS, BND, keeps costs near 0.03 to 0.07%. Returns of 8.7 to 11.2% annually since 2010. You don't need complexity. You need low costs, global diversification, and time. That's the whole game. Start today. Hit subscribe if you want to keep building your knowledge. New investing breakdowns every week, and it costs you nothing.